Joining us now on the phone for more on today's slide is David Nelson. He is the chief strategist for Belpointe. David, thanks for joining us.
Thank you.
So you heard that Marley there on the floor of the exchange talking to one of the traders, and I think for the folks that are watching this at home who may be looking at this 449 point drop right now in the market, that's still 2.75% drop in the stock market. It is a slide, but the fundamentals of the U.S. economy and U.S. companies are still strong, are they not?
Well, it depends on which sector of the economy that you're talking about. You know, we're in a manufacturing recession right now, and part of that is, you know, the strength of the dollar certainly hurts these companies. It makes our goods less attractive. Look, the story about China and the slowdown in global growth, it affects everything because the United States is not an island unto itself. We're all interconnected. There are some safe havens within the economy, and there are some places to put money. But generally, when you get these growth scares like we're seeing right now, where you're seeing big earnings misses from and poor guidance from companies like an Intel, that's a pretty big global concern. So when Intel gets hit, it kind of drags down a lot of the market. So there are concerns out here, some of them justified, some of them not.
Let's talk about Iran. The Iran nuclear deal set to take effect, those sanctions on Iran set to be lifted. Some of this panic on Wall Street, the slide we're seeing in the prices of oil have to do with Iran, you know, going to create a huge increase in supply of oil.
It's part of the equation. Part of it is demand because demand globally is lower. But we're in a new paradigm right now. We live in a world with the Saudis and OPEC pump full out. The United States currently pumps more than it imports. So we're drowning in oil right now. And of course, as I said earlier, that's a blessing and a curse. We benefit at the pump. That's wonderful. It's more money in our pocket. But if you're living in one of the oil-producing states, your economy there and maybe even your job is getting hard hit. So it's a concern. It starts to spill over to some other parts of the economy. Some bank CEOs like Brian Moynihan of Bank of America, pretty large bank, they're actually monitoring the credit profiles of some of their customers that live in those states. So it's all interconnected here, and I don't want to write off that it's just Iran, because Iran just adds more fuel to the fire here.
Yeah, you know, David, it's interesting. There are a lot of folks who are watching this, and they're probably worried. They've got 401ks, they've got 529 plans, they have plans to put their kids through college, or they want to buy a house or take a vacation, whatever it is. I think, you know, and just for your information, I spent 20 years at AllianceBernstein before I became a reporter. There was always a sense from people when they see things like this that they should sometimes make a move. They should call their financial advisor and say, you know what, I don't like what I'm seeing right now on my TV screen. You should sell my portfolio or move me into something else. And that was always the wrong advice, right? Because as the market is going down, that's probably the worst time that you want to be making moves, especially as we are generally thinking about an investor profile for 3 to 5 years down the road.
That's very true, Vlad. And the problem with market timing, something like that, when you're not doing it quantitatively, professionally, you're reacting to emotion, and there are two events that have to take place for that to be a good move. One, you have to get out right. Okay, even if you get that right, will you get back in right?
Right.
A lot of people got out sometime in 2008, and maybe for a while, that felt really comforting, and maybe it even saved them some money. But they probably didn't get back in until the market was well up late in 2009, and it probably ended up costing them money in the long run.
The U.S. markets are closed on Monday. Markets around the world will be open, including in China. Is that part of what's creating jitters on this Friday for investors?
I think whether the market would have been open or not on Monday, it's part of it. It is a Friday. I think one of the concerns, and I think traders on the floor would agree, we went through the September low in the S&P 500. That kind of exacerbates the selling. We're not quite at the lows right now, but a lot of people just don't want to go home long over the weekend. The market's changed over the last 10, 15 years. Some rules have changed within the market. The onslaught of ETFs, the quantitative trading on the market kind of exacerbates the moves. We seem to move farther in both directions, so the euphoria takes over, and we shoot up very, very hard. Even yesterday was an example of that. And on days like today, the program trading exacerbates that move. We lost the uptick rule, which was with us for, probably since the crash of '29. When we had the uptick rule in terms of shorting the market, that puts more pressure on the market. I think people are just kind of frightened today. They're seeing some things they don't like, and they just want to be a little more comforted over the weekend, and raising cash will do that.
Yeah, David, it's funny. When I was in high school, senior year of high school, I was working with my buddy on the floor of the exchange. We were sort of runners for the $2 brokers back then, and I was there. I was around that time when the market crashed in 1987. For context, when people look at the stock market, let's put that up right now. We see the market down 2.99%. If you recall, David, the market dropped 22% that day. That's what we were talking about in 1987, and so I remember that day very vividly. Traders essentially crying at their desks. We're not seeing that today.
No, so it puts it in perspective.
We're not going to see that. We do have circuit breakers, so it'd be very difficult. That could certainly happen over a series of days and even weeks. In the end, it doesn't much matter if you lose that much money in such a short period of time. But yeah, when I first got in the industry, I talked to people who had been on the floor of the New York Stock Exchange when that happened, and it was a pretty horrific event.
It was bad.
We're not going to see anything like that, but we are dripping down here, and investors are concerned, and I can sympathize with that.
All right, David Nelson, thank you so much. We appreciate it.